Now speaking, Tiffany Kanaga, Vice President, Global Investor Relations. Walgreens Boots Alliance held their Q3 FY 2023 earnings call, with Tiffany Kanaga, VP of Global Investor Relations, Roz Brewer, CEO, James Kyo, CFO, John Driscoll, President of U.S. Healthcare, and Rick Gates, Senior VP and Chief Pharmacy Officer, in attendance. They discussed the impact of COVID-19, which includes the distribution of vaccines, drive-through tests, and OTC tests in the U.S. They also cautioned that projections and forward-looking statements made during the call could differ materially due to a number of factors. The press release and slides referenced on the call contain further information about non-GAAP financial measures and are available in the Investors section of the Walgreens Boots Alliance website. Now speaking, Roz Brewer, Chief Executive Officer. The third quarter of 2023 saw Walgreens return to adjusted earnings growth of nearly 4%, with sales increasing almost 9% in constant currency. U.S. comp sales were up 7%. However, the company's overall performance did not meet expectations and they have had to revise their fiscal 2023 guidance accordingly. Several dynamics created margin pressures, including changing market trends as consumers prioritize value in response to a more uncertain economic environment, a steeper drop-off in COVID vaccines and testing, and slower profit ramp for U.S. healthcare. Despite this, Walgreens remain committed to their strategy and are taking immediate actions to accelerate their path to profitability. Progress has been made against each of their 4 strategic priorities, including the announcement of a scalable partnership with Telefarm to expand telepharmacy services. U.S. retail gross margin is up over 100 basis points year to date, and healthcare has gone from zero sales contribution 2 years ago to an $8 billion run rate in Q3 2023. The company has also realized $4.1 billion in proceeds from the sale of ABC shares this fiscal year and exited their Option Care Health position for $800 million in proceeds. External factors contributing to decreased profitability include lower than expected COVID-related demand, a cautious and value-driven consumer, and a weaker respiratory season. Walgreens is expecting to administer 9 to 10 million COVID vaccines next year, compared to 12.5 million this year. They anticipate these external pressures to persist into the fourth quarter, but are confident of accelerating adjusted operating income growth in the fourth quarter. Now speaking, Roz Brewer, Chief Executive Officer. The updated guidance for fiscal 2023 is for adjusted EPS of $4 to $4.05, representing core earnings that are flat to up 1% excluding COVID and currency. Fiscal 2024 guidance is for low to mid-single-digit adjusted operating growth, with the U.S. retail pharmacy and U.S. healthcare businesses more than offsetting headwinds from COVID, sale and leaseback, and ABC. OI growth should outpace adjusted EPS due to offsets from higher tax and non-controlling interest. To drive shareholder value, Walgreens has implemented a transformational cost management program savings goal of $4.1 billion, capital and project spend reductions, and working capital optimization program. It has also undertaken portfolio simplification in several initiatives to accelerate the U.S. healthcare business. These actions, along with improving quality of earnings, support long-term, low teens adjusted EPS growth over time. Examples of how Walgreens is driving value through its integrated portfolio include team-based healthcare delivery, digital connections and standalone clinics, healthcare concierge programs, an integrated pharmacist ambulatory care model, durable medical equipment benefit management solutions, single contract pharmacies, and at-home testing programs. Now speaking, James Kyo, Chief Financial Officer. The company reported 8.9% sales growth on a constant currency basis for the third quarter, led by its U.S. pharmacy business, up 10%, its Boots UK retail business, which delivered a solid 13% comp, and its scaling healthcare business, which added $1.4 billion in sales versus the prior year. Adjusted EPS increased 3.6% on a constant currency basis despite a 19 percentage point headwind due to a lower COVID-19 contribution and 8 percentage points from reduced ownership of AmerisourceBergen. The company has lowered its fiscal 23 adjusted EPS guidance to $4 to $4.05, reflecting consumer and category trends, a lower contribution from COVID, and an overall more cautious forward view given the continued macroeconomic uncertainty. The U.S. retail pharmacy segment saw sales increase 4.4% in the quarter with comp sales up 7%. Pharmacy sales increased 6.3%, driven by both script growth and brand inflation. Excluding immunizations, comp scripts grew 2.8%, a slight deceleration from the prior quarter and reflecting broader prescription market trends. Gross profit declined 3.2%, reflecting a 5 percentage point negative impact from COVID-19. Without the COVID-19 impact, gross profit increased as script growth and lower cost of goods sold more than offset reimbursement pressure. In the U.S. retail business, excluding tobacco, comp sales grew 0.2%, held back by 90 basis points due to holiday seasonal weakness as consumers pulled back on discretionary spending, and 80 basis points due to lower sales of COVID-19 OTC test kits. Grocery and household sales were up 4.7%, and beauty was up 3.7%. Cough, cold, flu sales were flat but slowed significantly in May due to a decline in respiratory incidences. In the international segment, sales increased 7%, with Boots UK up 10%, and Germany wholesale growing 4%. Adjusted operating income of $208 million increased 21% despite a $40 million year-on-year headwind from sale and leaseback transactions. For Boots UK, pharmacy comp sales increased 6%, and comp retail sales grew 13%. Boots.com sales grew 25%, and now account for over 14% of UK retail sales. Now speaking, James Keogh, Chief Financial Officer. Our international business will be a key driver of growth, as we continue to expand the UK market and capitalize on our leading position in Germany. This quarter, U.S. healthcare sales more than doubled from the prior year, reaching $2 billion with pro forma sales growth of 22%. Village MD sales were $1.5 billion, up 22% on a pro forma basis, driven by expansion of the clinic footprint with an additional 93 clinics opened in the past year and maturation of existing clinics. Shields had another strong quarter, up 35%, due to contract wins including 6 new health system partners and expansion of existing partnerships. CareCentrix sales were approximately $360 million with pro forma sales growth of 15%. Cash flow was $1.2 billion with free cash flow of $116 million. Village MD managed 850,000 value-based lives at quarter end, growing 27% year-over-year. Clinical trials business expanded with 8 contracts signed and a robust pipeline. Guidance for full year 23 adjusted EPS is $4 to $4.05, a constant currency decline of around 20%. Excluding COVID-19 and Forex, core adjusted EPS is flat to up 1%. U.S. retail pharmacy sales projected to be up low single digits year-on-year, AOI projected to be $3.8 billion to $3.9 billion, down 24%, international segment sales projected to grow 6% to 8%. U.S. healthcare sales projected to be $6.3 billion to $6.8 billion, up 25%. Adjusted EBITDA loss projected to be $340 million to $380 million. Full-year tax rate expected to be around 12%, fourth quarter EPS projected at 70 cents to 75 cents. 2024 performance expected to be influenced by continued weakness in consumer spending, moderate labor cost increases, reimbursement pressure, lower sale and leaseback activity, and higher tax rate. Profit drivers include first full year of Summit Health, maturing Village MD clinic profile, and expansion of UK and Germany markets. Now speaking, John Driscoll, President, U.S. Healthcare. Walgreens is disappointed with the pace of their path to profitability in the U.S. healthcare business, due to underperformance from Village MD and City MD directly related to a reduced cough, cold and flu season, as well as softer market demand. In order to improve profitability, Walgreens is taking immediate action by right-sizing its cost structure and optimizing overhead and revenue synergies to better match market demand. Additionally, they are recruiting experienced healthcare CFO Rich Rubino to lead the combined Village MD/Summit business. The company is also implementing a 3-year plan to improve performance through operational excellence and cost optimization. Walgreens is focused on gaining density in existing markets to accelerate Village MD's path to profitability, integrating digital assets with the Village MD platform, and recruiting new leadership to accelerate cost control. They are also leveraging Walgreens' reach, consumer engagement, and investments in primary care, specialty, and care to the home to build a differentiated value-based care delivery model. In addition, they are investing in targeted marketing campaigns to increase the patient base at City MD sites. Finally, they are raising and accelerating their synergy capture goal to $200 million in 2026. Now speaking, James Keogh, Chief Financial Officer. The company remains focused on core business investments, debt paydown, and the dividend. They are simplifying their portfolio to unlock value and maintain investment-grade rating. The transformational cost management program has been successful, with $3.3 billion saved by the end of this year and a 2024 savings target increased to $4.1 billion. This includes organization restructuring, which resulted in the elimination of 500 roles and optimizing the pharmacy of the future operating model. In addition, there will be 300 more store closures in the UK and 150 in the US. There have also been monetization efforts such as fully exiting Option Care Health with proceeds of $1.2 billion and using a variable prepaid forward structure for Amerisource, Bergen shares worth approximately $5 billion. Now speaking, Roz Brewer, Chief Executive Officer. The Walgreens Boots Alliance, WBA, is taking aggressive steps to improve profitability and deliver long-term value for shareholders. WBA has the right model, strategy, skills, and sense of urgency in place to drive sustainable profit growth. The company is entering the next phase of their healthcare transformation and is working at a fast pace to address current challenges. J.P. Morgan Chase & Company analyst Lisa Gill inquired, "What is the current utilization trend in Village MD's Medicare Advantage and what opportunities exist with City MD not seeing COVID-19 visits?" John Driscoll replied, "Lisa, utilization at Village has been a mixed blessing for us. We are seeing cost control which positions us better as a managed care partner. City MD utilization had an impact on our lab and ancillary business, but we see potential to integrate lessons from Village to improve Summit and City's value-based model. We expect a 70% quarter-over-quarter improvement in healthcare EBITDA in Q4, so there are opportunities to optimize costs and value." Deutsche Bank analyst George Hill inquired, "James, with OCF running below the dividend through 3 quarters and not expected to grow meaningfully next year, how is the company thinking about the dividend? And with regards to RX reimbursement pressure for calendar 24, what are the early expectations? Will it follow prior year's leg down in pharmacy reimbursement?" James Kyo replied, "The reimbursement environment for the current fiscal year saw a 15% step down compared to the previous year. We anticipate more productive discussions with payers and providers due to our ability to bring more value to the table, such as medical insurance and improved outcomes for payers. Our capital expenditure curtailment and working capital programs will give us the firepower needed to maintain our dividend and investment-grade rating. Additionally, our stake in ABC is still worth $5 billion, providing further financial support." Rick Gates replied, "Right now, we are in negotiations for the upcoming year and cannot provide much insight into 2022. However, as James mentioned, our current reimbursement is in line with expectations this year. We have a positive outlook on healthcare conversations that are taking place and are actively working to offset any reimbursements pressures by improving procurement, increasing prescriptions, providing ancillary services, and reducing cost to fill. Additionally, we are outperforming in pay for performance-based contracts which are included in our reimbursements. At this time, we are in line with expectations for 2021 but cannot provide information on 2022 yet." Mizuho Securities analyst Ann Hines inquired, "Given healthcare is the main driver of growth next year, what is the biggest risk embedded in your guidance? Additionally, what factors are driving the lower than expected scripts, market weakness, market share weakness or pharmacy hours?" John Driscoll replied, "Ann, I'm very encouraged by the core growth across our portfolio. We're aware of the challenge in costs and profit opportunity and are completely focused on executing to maximize value. We'll keep unlocking the embedded profitability of that portion of the business. Positive signs from all buyers give us confidence, and we'll stay diligent in ensuring consistent improvement in performance over time." Roz Brewer replied, "At the end of the quarter, we had 1,600 stores operating on reduced hours. We optimized those hours in 500 stores, reducing the total to roughly 1,100. Our pharmacy staffing also improved, with 1,100 new pharmacists hired. This enabled us to return some stores to regular full-time hours. Initial incentives have been successful, but now we're facing a limitation in available pharmacists." Rick, can you elaborate on the script improvement? Rick Gates replied, "We're seeing 3% growth through fiscal year 23, driven by 4 key factors. Market growth has slowed quarter over quarter, but we've seen positive results from our contracted market access and care programs. Store hours returning to normal have lagged slightly, but we are still seeing positive year-over-year growth for both market access and adherence." James Kyo replied, "We expect significant core growth in the U.S. business next year, despite a non-operating headwind from lower sale and leaseback and a $290 million COVID-related headwind. We have identified over $1 billion of savings from our transformational cost management program, cost optimization, margin improvement, and synergies in the U.S. healthcare business. Additionally, our corporate and U.S. support office restructuring resulted in 500 reductions and exceeded $100 million savings." Bank of America Merrill Lynch analyst Mike Cherney inquired, "James, how can cost savings targets and contributions from sales leasebacks and ABCs affect the core underlying earnings of this business? How do they factor into the previously reported multi-year growth targets?" James Kyo replied, "COVID and sale and leaseback have presented us with headwinds in the 4th quarter, but we are still expecting core growth of 30 to 40%. We anticipate low to mid-single-digit operating income growth for the entire year, which translates into a low teens growth in adjusted operating income. The flywheel will be working more consistently in the U.S. business, contributing to our goal of low single-digit earnings power by 2024. Cohen and Company analyst Lucas Romansky inquired, "What ability have you seen to lower MLR from high 80s to mid 70s in some regions since adding new health plan partnerships? How do you plan to increase exposure to risk and how will this help drive earnings growth of the U.S. healthcare segment? John Driscoll replied, Lucas, thank you for your question. We are seeing a strong demand for both capitated risk and performance opportunities with our specialty pharmacy business, Shields. Our products and services strive to lower the cost of care while improving patient outcomes, which has resonated with all stakeholders. Our track record of success in delivering on both sides has allowed us to be the go-to partner for health plans and health systems. As a result, we anticipate more news about our portfolio of risk-based and performance-based products, which will help unlock the embedded profitability of our assets. Credit Suisse analyst A.J. Rice inquired, what is the incremental cash flow opportunity from working capital optimization? What leverage target are you aiming for in debt paydown? James Kyo replied, over the past 5 years, we have reduced working capital by $2.5 billion. We currently maintain higher than desired levels of inventory in our store and pharmacy departments. To address this, we implemented a multi-year program with initiatives such as micro-fulfillment centers, which aim to reduce inventory in our 8,800 stores through centralization. This program is estimated to produce $1 billion of working capital opportunity, and we have already achieved 40% of that goal. Additionally, we have new forecasting systems, an inventory management system, and perpetual inventory for pharmacy rolling out throughout the year. Our ultimate target is to achieve an investment grade rating from Moody's, and specifically 475. To reach this, we must improve our operating cash flow and pay down debt during fiscal 24. Evercore IC analyst Elizabeth Anderson inquired, could you discuss the potential impact of 340B on the U.S. pharmacy business, as well as the opportunity in fiscal 24 from Shields? Rick Gates replied, yes, I would agree with Rick's assessment. We are confident that our guidance for 340B production in fiscal 23 is accurate and achievable. We are keeping a close eye on the latest manufacturer actions and restrictions to ensure our projections remain valid. We are also working proactively with covered entities to help mitigate any potential headwinds as we look ahead to Q4. Additionally, we are seeing good traction from contract pharmacies that are signing up for services in the market. All of this helps provide us a good line of sight into what we've projected for this year. John Driscoll replied, I believe Shields is well positioned to capitalize on the growth of specialty pharmacy drugs. Our services platform provides best-in-class adherence and integrates well with hospitals requiring management of complex conditions, enabling us to partner effectively with 340B-related specialty pharmacies. We remain confident in the demand and sustainability of our contracts and are well placed to take advantage of this growing market. Nephron research analyst Eric Percher inquired, can you provide an update on the U.S. healthcare ramp and the contributions of each business to the FY24 outlook compared to 6 months ago? James Kyo replied, Eric, our base year has come in about 300 light versus expectations from 9 months ago. We've implemented a series of actions to address some slowness at building patient panels at Village and Summit. Year-on-year growth is still intact, but we're probably 6 to 12 months behind the original projections. We won't likely recover the 300 loss this year, but it's possible that 2024 may see slightly more growth than initially anticipated. Does that make sense? John Driscoll replied, I expect Q4 will see a 70% improvement over Q3. We're not providing 24 guidance yet, but we are seeing increased demand across all markets and taking swift action to unlock profitability. We are confident that by Q4 we will have more clarity to provide further guidance. James Kyo replied, Eric, to reiterate, the EBITDA loss in Q3 multiplied by 30% is what we will deliver. We are on track for achieving break-even EBITDA in Q4 and a positive EBITDA in the first half of 2021. Roz Brewer replied, thank you for your questions this morning. Our commitment to swiftly address our challenges and better execute on our priorities is strong. We're taking aggressive actions to improve profitability of our quality assets and turning the inherent growth into profitable growth. We have the scale and the skills to operate with urgency and drive the growth forward. We're focused on delivering value to our employees, shareholders, and local communities.